You hear about the stock market all the time. It's on the news. People talk about it. But what is it really? Think of it like a giant marketplace. Instead of selling apples or shoes, this market sells tiny pieces of companies. These pieces are called stocks. When you buy a stock, you own a small part of that company. It's like owning a single brick in a huge building. You become a part owner, a shareholder. This market allows companies to raise money for growth, and it gives folks like you and me a chance to share in their success. It's a fascinating place full of opportunity. Now, how does this market actually work? Well, there are two main parts. First, there's the primary market. This is where companies sell their stocks for the very first time. Imagine a company deciding to go public. They offer their shares to investors through an initial public offering, or IPO. This is their big debut in the market. The money from these sales goes directly to the company. They use it to expand, to develop new products, or to pay off debts. It's the first chance for investors to get in on the ground floor, so to speak. Then there's the secondary market. This is what most people think of as the stock market. After the IPO, those stocks are bought and sold between investors. The company itself isn't directly involved in these trades. Think of it like buying a used car. The car company made the car initially, primary market. But then people buy and sell that used car among themselves, secondary market. Famous places like the New York Stock Exchange, NYSE, or the NASDAQ are examples of secondary markets. Here, prices change constantly based on supply and demand. So the stock market is essentially a system. It connects companies needing capital with people who have capital to invest. It's a dynamic environment. Prices go up, prices go down. It all depends on how many people want to buy a particular stock versus how many want to sell it. Understanding this basic idea is the first step. It's not as complicated as it looks from the outside. It's just people buying and selling shares of businesses they believe in, or sometimes businesses they think will go up in price for a short while. The stock market isn't just an abstract concept. It's made up of real people and institutions. First, you have investors. There are two main types.
Retail investors are regular folks like you and me. We invest our own money, maybe for retirement or to save for a big purchase. We might not have millions, but every bit counts. We make our own decisions, often with the help of research or advice. We're the everyday participants trying to grow our savings. It's important we understand what we're doing.
Then there are institutional investors. These are the big players. Think of pension funds, mutual funds, insurance companies, and hedge funds. They manage huge amounts of money on behalf of many people or for their own large accounts. Because they deal in large volumes, their trades can significantly impact market prices. These are the professionals with teams of analysts. They have access to a lot of information and resources. They often have different goals and strategies than individual retail investors. They aim for big returns.
Brokers are another key group. You can't just walk onto the floor of the New York Stock Exchange and start buying stocks. You need a broker. A broker is a person or a company that buys and sells stocks on your behalf. They are the intermediaries. In the old days, you'd call your broker on the phone. Now, many brokers are online platforms. You log in, place your order, and they execute it. They charge a fee for this service, known as a commission or a spread. Choosing a good broker is very important for any investor.
Finally, we have market makers and exchanges. Exchanges are the actual marketplaces like the NYSE or NASDAQ. They provide the infrastructure for trading. Market makers are firms that provide liquidity. They are willing to both buy and sell a particular stock. This ensures that there's always someone to trade with. They make money on the difference between the buying and selling price, called the bid-ask spread.
All these participants interact, creating the vibrant and sometimes chaotic world of the stock market. Understanding their roles helps you see the bigger picture. With so much money changing hands, you need rules, and you need referees to enforce those rules. That's where regulators come in. In the United States, the main regulator for the stock market is the Securities and Exchange Commission, or SEC. Congress created the SEC after the stock market crash of 1929. Its mission is to protect investors and maintain fair, orderly, and efficient markets. They work to prevent fraud and ensure companies provide truthful information to the public. Think of them as the police of the financial world. The SEC has a lot of power. They can bring civil enforcement actions against individuals and companies that break securities laws. They require public companies to disclose meaningful financial and other information. This means companies have to regularly publish reports about their performance. This transparency is crucial. It helps investors make informed decisions. Without the SEC, the market could be a much wilder and more dangerous place. They try to level the playing field so everyone has a fair shot. Another important organization is FINRA, the Financial Industry Regulatory Authority. FINRA is not a government agency, but a self-regulatory organization. It oversees the operations of virtually every brokerage firm in the U.S. They write and enforce rules governing the activities of all registered broker-dealer firms and registered brokers. Their job is to protect America's investors by making sure the broker-dealer industry operates fairly and honestly. They also provide education for investors. They are on the front lines, dealing directly with the firms you might use. These regulatory bodies are vital. They work to ensure market integrity and investor confidence. While no system is perfect and bad actors sometimes slip through, these watchdogs play a critical role. They investigate market manipulation, insider trading, and other fraudulent activities. They set standards for financial professionals. Knowing that these protections are in place can give investors some peace of mind. However, it's still up to each investor to do their own homework. Regulators can't protect you from making a bad investment decision if the company was honest in its disclosures. Why do people invest in the stock market? The main reason is the potential for wealth growth. Over the long run, the stock market has historically provided returns that outpace inflation and other types of investments, like savings accounts or bonds. When you buy stock in a good company, and that company grows and becomes more profitable, the value of your shares can increase significantly. This is how many people have built substantial wealth over decades. It's not a get-rich-quick scheme, mind you. It's about patience. One of the most powerful forces in investing is compounding. Albert Einstein supposedly called it the eighth wonder of the world. Here's how it works. You earn returns on your initial investment. Then, you earn returns on those returns. It's like a snowball rolling downhill, getting bigger and bigger. If your stocks pay dividends, which are small payments companies make to shareholders, you can reinvest those dividends to buy more shares. This accelerates the compounding effect. Even small amounts invested regularly can grow into large sums over many years. Think about owning shares in a company that makes products you use every day. If that company does well, expands its business, and increases its profits, your piece of the pie gets more valuable. This potential for capital appreciation is a major draw. Of course, not every company will be a winner, but a diversified portfolio of stocks in solid businesses has a good chance of growing over time. The key is to think long-term. Don't get spooked by short-term ups and downs. Focus on the underlying value of the businesses you own. The dream of financial independence is what drives many to the stock market. It offers a path to grow your savings faster than just letting them sit in a bank. Imagine your money working for you, even while you sleep. That's the power of investing. It's about participating in the growth of the economy. Successful companies create jobs, innovate, and improve lives. By investing in them, you're not just trying to make money, you're also supporting that progress. It's a powerful motivator for many. Section 5. The flip side, understanding the risks involved. Now, it's not all sunshine and rainbows. Investing in the stock market comes with risks. It's crucial to understand this before you put your hard-earned money on the line. The value of stocks can go down as well as up. Sometimes prices fall sharply and unexpectedly. This is called market volatility. Many factors can cause this: economic recessions, political instability, bad news about a specific company, or even just general investor panic. You could lose money, even all of your investment in a particular stock, if the company goes bankrupt. One common mistake beginners make is not understanding risk tolerance. How much risk are you comfortable taking? If the thought of your investments dropping 20% in a month keeps you up at night, then perhaps very aggressive stocks aren't for you. Your risk tolerance depends on your financial situation, your investment goals, and your personality. It's important to be honest with yourself about this. Don't invest money you might need in the short term, like for an emergency fund or a down payment on a house next year. The market is too unpredictable for short-term needs. Another big risk is putting all your eggs in one basket. This is called lack of diversification. If you invest all your money in just one or two stocks and those companies run into trouble, your entire investment portfolio could suffer badly. Diversification means spreading your investments across different companies, different industries, and maybe even different types of assets. This way, if one investment performs poorly, others might do well, cushioning the blow. It's a fundamental principle of managing risk. It won't guarantee profits or prevent all losses, but it can help smooth out the ride. Finally, there's the risk of emotional investing. Fear and greed are powerful emotions. When markets are soaring, it's easy to get greedy and buy risky stocks, hoping for quick profits. When markets are falling, fear can cause you to sell good investments at a loss. Successful investors try to keep their emotions in check. They stick to their investment plan. They don't panic sell or chase fads. Understanding these risks isn't meant to scare you away, but to prepare you. Knowledge is power, especially in the world of investing. Section 6. Your first steps. Getting your feet wet in investing. So you're ready to consider investing. Great. But where do you start? The very first step is to define your investment goals. What are you investing for? Is it for retirement in 30 years? A down payment on a house in 10 years? Or maybe just to grow your wealth over the long term without a specific deadline? Your goals will heavily influence your investment strategy, including how much risk you should take. Someone investing for retirement decades away can generally afford to take on more risk than someone saving for a short-term goal. Once you have your goals, think about your risk tolerance. We touched on this earlier. How comfortable are you with the possibility of losing money in the short term for the potential of higher long-term gains? Are you a conservative investor, a moderate one, or an aggressive one? There are questionnaires online that can help you figure this out. Your age, income, financial obligations, and even your temperament play a role. Knowing your risk tolerance will help you choose the right types of investments and build a portfolio you can stick with, even when the market gets choppy. Next, educate yourself. Don't just jump in blindly. Read books about investing. Follow reputable financial news sources. Understand basic financial terms. Learn about different types of investments. The more you know, the more confident you'll feel. I always say invest in what you know. If you understand a company's business, how it makes money, and its competitive advantages, you're in a much better position to assess its stock. You don't need to be a financial genius, but a solid foundation of knowledge is essential. Finally, start small. You don't need a fortune to begin investing. Many brokerage accounts have no minimum deposit. You can start with a modest amount and add to it regularly. This is called dollar cost averaging, and it's a great way to build your portfolio over time without trying to time the market, which is nearly impossible. The experience of investing, even with small sums, is valuable. You'll learn how you react to market movements and become more comfortable with the process. Remember, investing is a marathon, not a sprint. Section 7. Opening the door. Choosing your brokerage account. To buy and sell stocks, you need a brokerage account. This is your gateway to the stock market. Think of it like a special bank account designed for holding investments. There are many brokerage firms out there, from big, well-known names to newer online platforms. Choosing the right one is an important step. You'll want to consider factors like fees, the range of investment options offered, research tools, customer service, and ease of use. Take some time to compare different brokers before you commit. There are different types of brokerage accounts. A standard brokerage account, also called a taxable account, is the most common. You can buy and sell various investments like stocks, bonds, ETFs, and mutual funds. Any profits you make are subject to capital gains taxes. Then there are retirement accounts like a 401k if offered by your employer, or an individual retirement account, IRA. IRAs, such as traditional IRAs or Roth IRAs, offer tax advantages. Contributions to a traditional IRA might be tax-deductible, and investments grow tax-deferred. With a Roth IRA, contributions are made with after-tax money, but qualified withdrawals in retirement are tax-free. Opening an account is usually a straightforward process. Most brokers allow you to apply online. You'll need to provide personal information, such as your social security number, date of birth, address, and employment details. You'll also likely be asked about your investment experience and financial situation. This is partly for regulatory reasons, and partly to help the broker understand your needs. Read the account agreement carefully before you sign up. Understand the fee schedule. Some brokers charge commissions per trade, while others offer commission-free trading for certain investments. Once your account is open, the next step is to fund it. You can usually transfer money from your bank account electronically. Some brokers might also accept checks. Start with an amount you're comfortable with, keeping in mind your investment goals and risk tolerance. Don't feel pressured to invest a large sum immediately. It's perfectly fine to start small and learn the ropes. Having the account open and funded is a big step. You're now ready to start thinking about what investments to make. It's an exciting moment. Section 8. Placing your bets. Understanding how to buy and sell. Once your brokerage account is funded, you can start buying stocks. But how do you actually place an order? There are a few basic order types you should know. The simplest is a market order. When you place a market order to buy, you're telling your broker to buy the stock at the best available current price. It usually gets executed very quickly. The same goes for a market order to sell. The advantage is speed and certainty of execution. The disadvantage is that the price might be slightly different from what you saw a second ago, especially for volatile stocks. Another common type is a limit order. With a limit order, you set a specific price at which you're willing to buy or sell. For example, if a stock is trading at $50, but you only want to buy it if it drops to $48, you can place a limit order to buy at $48. Your order will only execute if the stock price reaches your specified limit or better. This gives you more control over the price, but there's no guarantee your order will be filled if the price never reaches your limit. It's a good tool for patient investors. Then there's the stop-loss order, sometimes called a stop order. This is a risk management tool. You set a stop price below the current market price for a stock you own. If the stock falls to that stop price, your order becomes a market order to sell. The idea is to limit your potential losses if the stock price drops significantly. For example, if you bought a stock at $100 and set a stop loss at $90, your shares would be sold if the price hits $90. It's not a perfect guarantee, as the sale might occur at a price slightly below your stop price in a fast-moving market, but it can offer some protection. Understanding these order types is fundamental. Most online brokerage platforms make it easy to select which type of order you want to place. Always double-check your order before submitting it. Make sure you've selected buy or sell correctly, entered the right stock symbol, the correct number of shares, and the appropriate order type and price if applicable. Mistakes can be costly. Take your time, especially when you're starting out. Familiarize yourself with your broker's trading platform. Practice, perhaps with a small amount, until you feel confident. Section 9. Playing the long game strategies for lasting wealth. So you've got your account, you know how to place orders. Now what's the strategy for long-term wealth? First, it's important to distinguish between investing and trading. Investing is typically long-term. You buy shares in companies you believe have strong fundamentals and hold on to them for years, even decades. The goal is to benefit from the company's growth and compounding returns. Trading, on the other hand, is usually short-term. Traders try to profit from frequent price movements, buying and selling stocks over days, hours, or even minutes. Trading is much riskier and requires a lot more time and skill. For most people, investing is the more sensible path. One popular strategy for long-term investors, especially beginners, is passive investing. This often involves using index funds or exchange-traded funds, ETFs. An index fund is a type of mutual fund that aims to replicate the performance of a specific market index, like the S&P 500, which represents 500 of the largest U.S. companies. When you invest in an S&P 500 index fund, you're essentially buying a tiny piece of all 500 of those companies. This gives you instant diversification. You're not betting on one horse, you're betting on the whole race. ETFs are similar to index funds in that many of them also track an index. However, ETFs trade like stocks on an exchange throughout the day. Index mutual funds typically price only once at the end of the trading day. Both index funds and ETFs usually have very low fees, which is a big advantage. High fees can eat into your returns significantly over time. Passive investing is passive because you're not actively trying to pick winning stocks or time the market. You're simply aiming to match the market's overall performance, which historically has been quite good over the long haul. The benefits of passive investing through index funds and ETFs are clear diversification, low costs, and simplicity. You don't need to spend hours researching individual stocks. It's a great way to get started and build a core portfolio. However, there are limitations. You won't beat the market with an index fund, you'll essentially be the market. And if the whole market goes down, your investment will go down too. But for long-term wealth growth, a consistent strategy of investing in low-cost, diversified index funds, or ETFs, and regularly adding to those investments is a proven approach. It's about patience, discipline, and letting the power of compounding work for you over many years.